Hi there. Welcome to The Open here on BNN Bloomberg. I'm Lindsay Biscaya, filling in for Andrew Bell today. And now let's get to some of the stories we're following in the BNN Bloomberg newsroom. Finance Minister François-Philippe Champagne is in China for the next 4 days. The trip is aimed at building closer strategic and economic ties. His office said the visit would build on Prime Minister Mark Carney's trip to China in January, adding he will meet government and business leaders to build strategic partnerships and attract new investments. Shares of Nike are plunging in the pre-market after the sportswear company gave a gloomy outlook for the year ahead. Revenue is expected to fall 2 to 4% in the current quarter and continue to be in the low single digits for 2026. Nike is being impacted by elevated inventories in Europe and the Middle East and traffic disruption from the war. Weakness in China and other markets also overshadowed strong results in North America. Fourth quarter profit for Group Dynamite, meanwhile, more than doubled compared with a year earlier. Revenue rose by 45% on increased in-store demand and strong online sales. The Quebec-based company also expanded its Garage brand in the UK in early 2026. The retailer posted a strong outlook for revenue growth for the full year, but cautioned for multiple risks, including tariffs, a decrease in customers, and failing to open new planned stores. And we'll take a look at U.S. futures at the moment, all trading up right now. The TSX as well is up. It actually finished up more than 800 points yesterday with some broad-based gains driven by optimism that the war in Iran might soon come to an end. And we're seeing that throughout all the markets, even in Asia, in Europe. There's a lot of optimism in terms of what Donald Trump might say later today when he gives an address to the nation. And we'll obviously be watching for that. Let's start with some perspective, though, on the earnings results from Nike and Group Dynamite. Joining me now is Jamie Murray, president of the Murray Wealth Group. It's great to have you. Thanks for joining us. Good morning.
Yeah, thanks you for having me on.
We'll start with Nike. Probably not the results that the company wanted to see. Were you expecting these kind of results from Nike and the kind of gloomy outlook for the year ahead?
Yeah, I mean, certainly the results were disappointing, missing, I think, a lot of analysts' numbers on, especially on the top line on the revenue side and on the inventory side, which those have been the problems plaguing Nike for the last 3 or 4 years. And so, I mean, we're not necessarily surprised to see that continue. We used to be Nike shareholders once upon a time, going back to the 2020, 2021 days when they're moving all in on digital and you know, the merchandise was flying off the shelves. But, you know, we realized they overextended, over-pivoted towards the direct-to-consumer model. They gave up a lot of shelf space on wholesale, and that allowed new competitors to move in. And now their merchandise is a little bit stale. They haven't really had any new product innovation that's really got consumers excited. And so I think Nike, and why the stock is down, is its investors realizing this turnaround is going to be a longer, process than expected.
So obviously Nike has its own problems that are kind of like company specific. You don't think that this is a bigger story, like a broader story in terms of the retail sector as a whole, and maybe a story of what economies really around the world are looking like?
I mean, I think that plays a part into it. Certainly we're seeing, and I know we'll talk about Group Dynamite, but there are retailers who are thriving in this market. And it always comes down to having the right product, the right price point, and delivering something that consumers want. But we are seeing, obviously, like the Lululemons of the world as well, struggling with a slower apparel and athletic market, whether that's just new competition, consumer fatigue, the health of the consumer in general. These are all factors at play, but I think Nike's issues, while those are a part, they lay deeper than that.
Okay, yeah, let's talk about Group Dynamite then, as you said. So a totally different story for this company, posting some pretty strong results. Revenue more than doubled compared with a year earlier, rose 45%, strong revenue growth and outlook for the year ahead. What are your thoughts on what we saw from Dynamite?
Yeah, really impressive quarter from Dynamite. This is a company that they just IPO'd about 18 months ago, I think it was. And so they're still a little bit in that show me, prove me phase where they have a new business model. It's a little bit more of a fast designed, quick turnaround model, high inventory turns. It seems like it's working. I mean, the comp sales are great. The outlook for 2026 was great. It looks like it was above estimates, mostly due to higher same-store sales. And so they're doing everything right. They've got a great multiple now. It trades at, I think, 30 times PE. So a lot of this growth is priced in, and it's going to be up to them to keep delivering quarters like this. But we certainly think this is going to move the stock higher today.
Moving it higher today, but as you mentioned, like the company has caution for the year ahead, multiple risks, including tariffs, a decrease in customers, and failing to open some new planned stores. Does any of that kind of concern you for the company as we move further into 2026?
So, I mean, these are all risks that a lot of retailers face. Certainly, I think Dynamite's just highlighting here's what could happen that would not allow us to meet these guidance numbers that we're laying out for the street today. And so certainly any of those things are possible. It's possible the war in Iran and expands or grows, and that could be another factor. So a lot of these risks, I think, are just ongoing business risks and not necessarily specific to Dynamite or ones that they're saying they expect to happen. But definitely these are all things we track, and it's great now with a lot of data sources, and why I think a lot of investors were really bullish on this quarter for Dynamite is we can see almost not quite real time, but with a short lag, how credit card sales are trending in, say, the United States or in Europe. Even in Canada, there's broader credit card data sets. And so we do get a good sense how these risks are playing out through the quarter.
Okay, so we're going to move on and take a broader look at the markets now before we hone in on some. I know you have some stock picks, and we'll get to those. But just what we're seeing today in terms of the roller coaster with the markets. It seems as though a lot more trading in the green today. What are your thoughts on the volatility right now? Is there anywhere you think investors should be looking that's maybe a little more stable?
Yeah, I mean, it's definitely tough to trade in this volatility. We're long-term investors. We buy and hold stocks for years, and so we expect that we're going to go through periods like this, and we just like to hold companies that we think are going to come out of these global geopolitical or COVID or whatever it is, these global crisis events, stronger on the other side. And that's really how we deal with them, is like we just deal with them by saying, hey, we just want to own something that I know is going to be okay when this is all over, whatever the outcome is. So say what's going to happen today in the market looks like it's going to be a strong start. But, the war is continuing. It's not over until it's over. We'll see what President Trump says tonight in his address to the nation. It's about 1 year ago on Liberation Day when he had a similar address and sunk the markets 10% over 3 days. But he could say something that, continues the rally. So we're just, again, positioned in long-term holds and playing the market like that.
Mm-hmm. Okay, so let's get to your stock picks. You've got one that you would buy and one that you would sell. We'll start with the buy. Flowserve is a company you like. Why do you like Flowserve?
Yeah, so Flowserve is a recent addition to our global equity growth portfolio. And one of the spots we're seeing some opportunities is companies that are adjacent to the oil and energy sector that have seen their share prices get hit on this war in Iran. So we fully expect, like Flowserve, they make pumps and valves, pretty basic industrial products that go into LNG plants, nuclear facilities. And so we fully expect that whatever the outcome of this Middle East scenario is, we're going to see more LNG built globally, whether that's in Canada and the US, potentially, some more in Africa or even other Australia. So we're going to see a big build cycle that we think is going to come from this. As well, nuclear is another pillar to the story where we've already seen lots of momentum in the nuclear sector. And so Flowserve is just a great way to play a broad-based pivot to those two forms of energy as we come out of this crisis.
And just lastly, one to sell is Starbucks. Why's that?
Yeah, so Starbucks, this was a holding of ours for the last few years, and one that we actually did sell, mostly due to some of the concerns that we're seeing. And Starbucks being consumer discretionary, like we were talking with Nike, it is a tough market with consumers a little stretched, and seeing gas prices, hit decade highs really doesn't help the story when you're thinking, hey, should I stop in for that $6 latte? But your bill at the pump just went up, $30. These are some of the first things to get cut. And so Starbucks is a company that we have held for this turnaround that the new CEO is putting in place. It's taking a little bit longer than we expected. The investments they're having to make in their labor force are a little bit bigger than we expected. And now seeing the stock trade at a 30 times multiple, given some of the perceived slowdowns we're going to see in the consumer sector, we decided to exit Starbucks.
Okay, we're going to have to leave it there. Jamie Murray, president of the Murray Wealth Group, joining us this morning. Thanks so much for your time. I appreciate it.
Yeah, thank you.
Coming up, we will bring you an in-depth check on the markets, and then we'll tell you why, despite a decline in cocoa prices, don't expect a deal on Easter candy this year. That's next. Welcome back. Here's how things are shaping up on the markets today. We'll begin with the U.S. futures. Looking like yesterday's rally on news of a potential end to the war is carrying into today. We'll have to see when the markets open. But it seems as though investors are very optimistic that maybe we're going to see an end to this war in Iran. Of course, Donald Trump speaking later today. And if we look at how major Asian markets finished the day today, obviously done trading, the Nikkei had its largest single day gain of the year. And you're going to see this optimism really across the globe today, in Asian markets also seeing some optimism today, given the fact that maybe Donald Trump will say something tonight about the potential end to this conflict in the Middle East, which has kept the Strait of Hormuz closed for weeks now. And if we move over to look at how Europe is trading today on the major European markets, the FTSE is up by more than 1%. Same with the CAC, and the German DAX is up by more than 2%. So obviously that optimism spreading there as well. Let's take a look at where the TSX finished the day yesterday. Like everywhere, pretty much index-wide rally led by materials and tech, which were up 6% and 5% respectively. The energy index, the only one in the red. TSX up more than 800 points to finish the day yesterday. So seeing some gains after a couple of days of losses. Here's a look at the biggest winners and losers on the TSX composite from a percentage standpoint. G Mining was the biggest winner of the day, up more than 13%. Curaleaf also up more than 13%. And if we take a look at some of the biggest laggers, it, of course, is the energy sector. Methanex is down by almost 5%, and Advantage Energy down by more than 3%. We'll take a look at the price of metals to start the day. It seems as though people are heading back to gold, with it surging again. Gold up almost 2%. Silver also up at the moment. And copper unchanged. And we'll take a look at crude oil as well. Oil down almost a full percentage point. So we're watching this kind of flip-flop today. Again, there is optimism that the Strait of Hormuz will open, which hopefully for most people would lower oil prices, and we're seeing that reflected today. Chocolate prices may be down on paper, but not at the checkout. Cocoa costs fell sharply over the past year, yet experts say consumers won't see relief in time for Easter. For more, we're joined now by CTV's Scott Hurst. Scott, good morning. So the price of cocoa may be dropping. Consumers not seeing a price break, though. What can you tell us about this?
Lindsay, good morning. Chocolate prices are actually up over the past year, even as cocoa prices have been plummeting. Unfortunately, nothing sweet in my reporting today, so don't expect any deals on Easter candy over the next several days. Chocolate prices are up compared to this time last year in the range of 10 to 25% for certain items, according to experts. But we've seen cocoa prices, they're down more than 60% than a year ago. Prices reached record highs in 2024 with poor weather wiping out crops. And in the wake of that, prices soared. So why is the price still so significantly elevated, even as cocoa prices are coming down? Well, experts say a lot of it has to do with time. The Easter chocolate in stores today, the rows upon rows of chocolate eggs and chocolate bunnies, those were produced months ago, and industry analysts say the cocoa prices you see today may not be reflected in what you see on the shelves as packaged chocolate, Lindsay, for up to 12 months. And even if the price isn't up, maybe you're getting less. Producers have turned to smaller packaging, lighter weights, even less cocoa, the main ingredient, to help their costs in the production side.
Some of that shrinkflation we've been hearing about. And when it comes to like other impacts that Canadians might be facing as they prepare their Easter meals, what are they?
Lindsay, rising prices have been something that we've all been dealing with, particularly in the grocery aisle for some time, as we've seen overall food inflation remaining stubbornly high. Things like beef and poultry prices have climbed significantly over the past year. And of course, fears of inflation spiking yet again due to the war in Iran. We're already seeing the immediate impact on consumers in terms of gas prices. So all of a sudden it costs more to get around. And so if you're gathering for Easter or gathering for Passover, no doubt a lot of people will be noticing just how much more they'll have to pay to travel and to put on a spread for family and friends, Lindsay.
Okay, we'll leave it there. That is CTV's Scott Hurst joining us live. Scott, thanks so much.
Thanks, Lindsay.
Still ahead, Muddy Waters founder and CEO Carson Block says the market's focus on the Iran conflict may be missing the bigger story. We'll get his perspective in a Bloomberg interview right after this. Muddy Waters research founder and CEO Carson Block explains how the market's focus on the conflict in Iran is a distraction from what he considers to be the bigger story. Earlier, we got perspective from him in a Bloomberg interview. Take a listen.
The war in Iran, I mean, who knows? I think that this is a distraction from the really big story, which is what AI is going to be doing to the job market in the next several years. So to me, AI is going to change everything. So, look, if the war in Iran ends tomorrow and the strait reopens, markets are going to rip. That dynamic, I don't think there's a way to really trade that, or at least that I know of, to predict that. But what I am concerned about is the long-term health of the U.S. job market and the markets. So that's my focus. That's what I can look at on the long-term horizon.
Well, to follow up on that, I mean, you think about AI concerns. Even before we were talking about what's going on in the Middle East, that was the defining trade of 2026 year to date. You saw the SaaS apocalypse taking down a lot of the big tech names, the sector as a whole. I mean, in your view, it almost sounds like perhaps that was warranted.
Well, that was the wake-up call for me, because until then I hadn't really, I'd previously messed around with some earlier generations of ChatGPT and Gemini, but when I saw these software companies take a hit, I thought, I don't understand this. I think this would be good for software companies, right? They're going to be more productive, fewer employees. And then I learned, okay, there's concern about their pricing models. But that's what led me to really start digging into this. And, what I think the real issue here is that within a lot of the leading edge companies in technology, their best users of AI have been able to replace 7 of their colleagues. So these teams have gone from 8 people to 1 person with AI. And that's based on the current or even prior generations of AI models. And those AI models are improving exponentially because they are now, this generation has been coded and tested by its predecessor, and it's coding and testing its successor. And so we're no longer on this linear progression path. It's now exponential. So if I look out 3 years, I think, all right, well, if at present point in time, your best AI users have basically replaced 7 of their colleagues, well, I mean, in 3 years' time, with exponential improvement, what about the broader knowledge economy? Do we go from 7 to 6 workers? Is that unreasonable? Especially when we think about certain professions like law. I mean, I'm using Claude now to do legal documents that I used to get billed for. So I think this is going to be just beyond profound.
But I'm just looking at the Mag 7 year to date. Microsoft's the worst performer, down 23%. To your point, Gemini, you would kind of on the surface say they're the only publicly traded company with a real LLM that can be utilized. Why would that not be a place to kind of seek shelter relative to Apple, which is only down 6.5%?
Well, so this is where you get into this whole Mike Green, so Mike Green of Simplify Asset Management, he's been banging the drum for years about how passive has warped the markets. And so when you look at the indices, such as the S&P 500 index, so much of this is driven by passive buying, removing active sellers and squeezing the floats. So over the summer, when I was going back and forth with Mike, he told me that he thought that NVIDIA had a multiple of 100 on it, meaning for every dollar that went into NVIDIA, the aggregate market cap of NVIDIA increased by $100. And so that's great when everything is going well and you have these flows that are positive into SPY and other S&P 500 index funds. But if you have a situation in which there are layoffs and the people who contribute to the 401ks stop contributing to their 401ks and then start redeeming from the 401ks, those flows work in reverse, and those multipliers still exist. So that's when you get the falling knives. And there just aren't enough active managers and investors left, per Mike's theory, which I believe, to catch him. So, and look, to be clear, Mike has not endorsed this AI apocalypse, intersecting with his, market cataclysm due to passive investing. That's where I believe in Mike's view, and I think AI is what causes that cataclysm to occur.
Would you say then that the IGV, that software, still has more room to the downside then, broadly speaking, if this is a world that we do continue to see workforces shrink?
Well, so the thing is, almost everything has room to the downside. Yeah. That's the problem. Now, do I go and short a bunch of software companies because of that? No, we're setting up, we've set up our portfolio to protect our investors or maybe even capitalize on this AI disruption taking place. I mean, the timing is the part that, do we get the 15% of job losses in 3 years? Is it 4 or 5? I'd say 5 years I feel pretty good about that. But I think actually the best way to play that is in credit, in the idea that credit spreads are going to widen. So obviously your Mag 7 companies, if the index crashes because you get outflows, those will do poorly. If you believe in this thesis and you want to protect yourself, should you go and short Mag 7 right now? No, because a lot can happen between now and when this materializes. But I think putting on convex trades, like put spreads, long-dated, out-of-the-money put spreads on ETFs like HYG, LQD, I think that is a better way to play it, and you're capping your downside as well, which, when you're shorting things, risk management is the beginning and the end of everything that you do.
Yesterday on Market Call, we were joined by Mike Vinokur, portfolio manager and senior wealth advisor at Propellus Wealth Partners, IA Private Wealth. His focus was North American large caps, and these were his top picks: Microsoft, Uber, and Manulife. Joining us today on Market Call is Michael Sprung, president of Sprung Investment Management, and his focus will be Canadian large cap stocks. So be sure to tune in for that today at noon Eastern Time. And the opening bells are next. Stay with us. And here are the opening bells at the NASDAQ. Paloma Acquisition Corporation is ringing the opening bell. At the New York Stock Exchange, Versigent rings the opening bell. And at the TSX, Xanadu Quantum Technologies is opening the markets. We spoke to the CEO just on Friday. It's time now for the first 15. This is BNN Bloomberg trading just getting underway today. We're going to check in on the equity markets. The TSX, the S&P 500, the NASDAQ, all trading up this morning. Investors very much optimistic that maybe we could see an end to this war in Iran sooner rather than later. We're all waiting for an address to the nation given by U.S. President Donald Trump later today, which maybe will have more information in it. But it seems as though there is some optimism today. If we take a look at some of the big companies on the TSX, Go Easy is one we're watching today. A loss in the fourth quarter for this company. That loss deeper than expected. The firm says it expects loan write-offs to remain elevated for most of the year. And Go Easy to start the day is down by almost 7%. We're also watching Dynamite today. Group Dynamite releasing fourth quarter results, seeing profit, which more than doubled compared to a year earlier, as well as a revenue increase, and Group Dynamite benefiting from that today. Look, the stock up almost or more than 10% at the moment. And we're watching Methanex Corporation too. It finished bottom of the TSX yesterday, along with a number of other major Canadian energy companies. Seeing the price of oil dropping, which is affecting some of these companies. Methanex obviously dealing more with natural gas, but this company down by 0.4% to start the morning. And GFL, another company we're watching today because there is news that this company could be closing in on a deal to acquire Frontier Waste Solutions in Texas, a transaction that would reportedly be worth $900 million. GFL Environmental up more than 2% to start the day. Okay, for movers south of the border, we're now joined by Jeff Morgan, Deputy Team Leader for the Bloomberg News Equities Team. Jeff, good morning. Good to see you. So we'll start with...
Good morning. Good to see you as well.
We'll start with Nike. It's been a bit of a rough day for Nike, slumping after the Iran war and releasing results that kind of fell short.
Very much so. Very much so. They fell short. The company now expects to see revenue down 2 to 4% in this quarter, and so that is a big miss. The company has been on a kind of a long-term turnaround. It has been trying to regain market share that it has been shedding over the past number of years. And the CEO was out this morning saying that the plan, parts of the plan at least, are taking longer than he would have expected and longer than he would have liked. And indeed, investors are feeling the same way so far this morning. This is one of the worst performing stocks in the S&P 500. It's down as much as 12% in the pre-market session. It's worth watching over the course of the trading day here because this is such a big move down for such an iconic company. As I said, that turnaround plan is taking apparently longer than the company wanted and indeed longer than investors wanted. Not only are they still seeing kind of weak sales in China, they have a backup of inventories in the Middle East and in Europe, and they're seeing slower shipping times as a result of the war in the Middle East as well. So a lot of headwinds for Nike this morning, and the turnaround plan that they have been trying to execute going a little bit slower than they would have liked.
Yeah, the CEO saying that today, turnaround plan taking a little longer than he would have liked. You're also watching RH today, another company that was kind of trailing in its latest earnings report. Tell us more.
Yes, this company is getting hit really hard, down 20% in the pre-market session, and that move is big enough that it's worth watching. RH is one of these. It's a home furnishing retailer. You may be familiar with some very, very expensive couches and tables, and they sell all sorts of home furnishings. They are also looking at a 2 to 4% revenue drop in this quarter. Now that's notable because analysts on Wall Street had expected consensus 8% growth. So you're expecting 8% growth, you end up with a 2 to 4% drop. That is a big miss in terms of expectations. Bloomberg Intelligence, which is the in-house analyst shop that we have here, saying that this is such a remarkable drop that probably it won't be contained within the first quarter. The company is still maintaining that 8% growth outlook over the course of the year, but 2 to 4% in this quarter is big enough that that's worth maybe asking a few questions about that. That does seem to be what investors are doing right now with the shares dropping as dramatically as they have been.
For sure. Okay, we will leave it there. BNN Bloomberg's Jeff Morgan joining us live today. Jeff, thanks so much. Appreciate it. Coming up, we'll take a look at how one portfolio manager is handling market volatility and adjusting their portfolio. That's next. Stay with us. Markets are on the upswing this morning after U.S. President Donald Trump signaled he wants to wind down the war in Iran. But there's still a lot of uncertainty posing challenges for investors. Let's find out now how one portfolio manager has been rebalancing during the turbulence. Joining us now is Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. It's great to have you join us. Thanks so much.
Good morning. Thanks for having me.
So you say your message to clients has been around capital preservation and all this volatility. Tell us more about what that means.
Absolutely. Markets started acting a little bit rotational before the war started. Things like precious metals, silver started selling off. And then when the war started, other names started breaking down. And markets started to trade sloppy. Volatility rallied hard. And so it was a matter of moving from making money to preserving capital so that we have dry powder to re-engage when things stabilize and go back to trend. Because right now there is no trend except for what's strategically nerve-wracking, like what's going to happen to oil, what's going to happen to oil long term. So from an energy perspective, energy exposure, we have been overweight then, before the war, and we're still overweight now. But what we have done in the financials, technology, we have slowly raised some cash, and we are sitting with a substantial amount of cash, which is 30%. Now, we are participating in what the market's doing because 70% of portfolios are still invested, but they're invested. We've re-entered some of the golds, and we have, like I said, exposure to energy as well as some financials, but we have a pretty high cash component and a few new names that really fit this environment.
And I want to get into those in just a moment, but you've touched on a couple of points I want to talk about in more detail. You say you've been overweight in oil and energy kind of before the war. You still are. Do you foresee that changing if things develop in the Middle East and there's maybe an end to this war and oil prices potentially come down?
I don't see that changing based on current information. You know, we are invested in some of the larger cap energy names, Suncor, CNQ, Imperial Oil. There is no need to go down the capitalization curve. You get performance and oomph out of the large companies, not to mention that you get stability. Suncor had a great investor day yesterday, for example. They increased their free cash flow growth estimates. They've delineated their operational plan, increased their buyback. This is a company that shows like it's operating and kicking on all cylinders, new management, great operational efficiencies. So energy continues to be important, was important before. You know, we have a theme, price has to meet narrative for us. Energy stocks, and these stocks in particular, have acted well way before the war started. This just exacerbated their growth.
You also say like another major change you made a couple of weeks ago was re-entering into some gold names after getting out back when gold was around the 5,000 mark. That was back in like January, I think. Tell us about that decision to exit gold and the decision to get back into it.
Right. So going back to price has to match narrative. If investors remember the day, for example, that silver dropped 30% in one day, gold and silver were very overextended on the reflation trade and the dollar debasement trade. And so we were invested in names like Agnico Eagle, for example, large Canadian, safe geographically company, well managed. When the silver and gold started coming back and correct, now these are sectors that are highly volatile. The corrections can be multiple tens of %, and we were not willing to sit that out. So we have levels where we no longer are willing to take the volatility, and we exited. Now gold, for example, has come back right into their natural technical support level. These are good companies that we exited. And when we exit, we put them on the farm list for re-engagement when things stabilize. So we've protected a portion of clients' money. We don't try to pick tops and bottoms, but we try to stay away from volatility that can hurt and re-enter when the trend shows like it wants to reassert itself. And that's what happened. So we've re-entered Agnico Eagle, for example.
Agnico Eagle is one that you like. When we look at the markets and maybe they're starting to restabilize, or at least as you say, some sectors are, there was a bit of a rally yesterday that we saw. It seems to be continuing into today. What do you think contributed to that?
So certainly we're playing headline ping pong. The war is playing out not only in bombs and aircraft, but also a war of headlines. Every 5 minutes, you hear from one side or the other side playing out their agendas. But what contributed yesterday also to the huge move and triggered by the geopolitical events is month end and quarter end. The market participants have gotten extremely short. $190 billion went through the U.S. market in sales over the last month, over the period of the war. So there is, there is players in the market that are price insensitive. They are rule based. They're CTAs or volatility players, and they got very, very short. Now, in the absence of the big players, this cohort can really move markets, not to mention that there is a big market in levered ETFs, so triple exposure to NASDAQ, triple exposures to the S&P in the form of ETFs, which have to rebalance daily, and they exacerbate the direction. There were multiple billions of dollars having to be put to work yesterday to rebalance or to re-engage in that kind of ETF cohort into the later half of the day, and I think that contributed to at least half the rally.
And
yesterday.
with that said, there's another name that you like that you recently added to the portfolio. I don't know if I'm going to say this right. Bunge Global?
Bunge.
Bunge, okay.
Bunge Global. It's a fertilizer company. It's a vertically integrated agribusiness company, large, very large. This business doesn't have much competition. There's high barriers to entry and lots of complicated nuances. So Bunge operates in 40 countries, has 25,000 employees, and produces nitrogen fertilizers sourced in Latin America, made at local industrial facilities. So fertilizer is in play right now because the closure of the Strait of Hormuz affects about 30% of that business logistics, supply chain impact. And Bunge is a fully integrated farm-to-market system that connects fertilizer with crop production, processing, global distribution, trading. So many moving parts to this large company. So it has control over its logistics, which in this environment is very important. It gives them the ability to move commodities where prices are highest. And they're involved in trading and merchandising, arbitraging price differences, has a hedging system, and great access to global market intelligence, among other things. So this has been a name that we've recently added that directly comes out of the recent situation in the market.
Right. Okay. Well, we're going to have to leave it there. That's all the time we have. Diana Avigdor, Portfolio Manager and Head of Trading at Barometer Capital Management. Appreciate your time. Thanks so much. Just ahead, we will tell you what the latest irritant is when it comes to trade negotiations with Washington. That's next. Stay with us. Welcome back. Provincial rules around alcohol and the federal government's Buy Canadian policy have been flagged in a new report citing several trade irritants between Canada and the U.S. For more, we're joined now by CTV's Annie Bergeron-Oliver. So, Annie, good morning. We talked yesterday about beer, wine, and spirits going up in price. Today, beer and wine back in the headlines. What does this new trade report say?
That's right, Lindsay. Well, this trade report was prepared by the U.S. Trade Representative Jamieson Greer, and it's to be presented to Donald Trump, the U.S. president, as well as to Congress. And in it talks about trade irritants with Canada. And one of the aspects here that's highlighted is the fact that since March 2025, a number of provinces, including Ontario, have banned the sale of any type of American booze, whether that's wine, beer, or spirits. This report says that that policy is hampering the ability of American companies to sell their products in Canada. The report says this is an unfair trade advantage and disadvantage, and they want this practice to be permanently ended. Now, let's put this into context here. If you look at the numbers, the LCBO usually buys about $1 billion worth of American products every year. And again, those have not been on the shelves since March 2025. And almost every other province across Canada, except for Alberta and Saskatchewan, have similar policies in place. So this is just one aspect highlighted in this report, Lindsay, where the trade representative is saying that this is a trade irritant that they don't like and they want this practice ended permanently.
So interesting. When it comes to this report, are there other so-called trade irritants that have been highlighted?
There are. So, of course, they talk about supply management, saying that this makes it harder for dairy producers in America to come into Canada. This has existed for quite some time. It's been a up for debate in almost every negotiation when it comes to free trade agreements. They also talk about the fact that Canadian Transportation Agency takes a long time to approve new airplanes. And we know that the Americans, especially Donald Trump, wants the Gulfstream approved ASAP. So this is highlighted as well. But really the big one here is the Buy Canada policy. This was implemented by Mark Carney in December 2025. At the time, he said this was a way to help sectors, steel, aluminum, and wood, that had been heavily impacted by American tariffs. He said that Canada had to become the biggest buyer of Canadian products and helping Canadian businesses to ensure that the economy would get a boost despite some of these trade tensions that were ongoing with the United States. And the big change in this Buy Canada policy was what it did was it required Canadian companies, specifically the federal government, whether that's a Crown Corp or departments, as well as the Defense Department, to prioritize the use of Canadian products, specifically steel, aluminum, and wood, in any type of contract valued at $25 million and over. Again, Carney said at the time that this was a way to really help struggling Canadian industries. But in this trade report, they say that this is unfair, that it's hampering the ability of American companies to try to compete for major contracts in Canada. They're saying that this is a policy that shouldn't be in existence anymore, again, because American companies are concerned about how difficult it may be or is becoming to bid on Canadian contracts. So this is, again, a big part of what's highlighted in this overall trade report, talking about trade irritants. They want this change. So why quickly is all of this so important? Because trade talks are currently underway about and this renegotiation of it. We know that formal talks between Canada and the United States haven't started yet, but we know that unofficial talks between the two countries are currently underway. And it's not a guarantee that all of these things brought up in this trade report are being talked about behind the scenes, but it's a pretty good indication that at least a large number of these issues being highlighted today in the report are up for discussion in these background conversations that are happening between the Canadian and the American authorities, Lindsay.
So interesting. Okay, that's CTV's Annie Bergeron-Oliver joining us live with the latest. Annie, thanks for that. Meanwhile, the Alberta Whiskey Act is a new bill set to provide a new definition for Alberta whiskey in an effort to grow the local distilling industry. CTV's Tim Brooke has more in this report.
New parameters around Alberta whiskey will soon define exactly what makes this drink so sought after.
In simple terms, it means the product has to be made right here in Alberta from start to finish, using 100% Alberta water and primarily Alberta-grown grains.
The Alberta Whiskey Act is a new effort to grow the local distilling industry. Producers have been asking for clear labeling parameters for years as they try to differentiate their whiskey in a competitive market.
This starts putting the eyes on us, getting people to come to Alberta, in parallel with our tourism industry that is burgeoning right now and developing rapidly.
If Kentucky can bring in $9 billion annually, we are the breadbasket of Canada. We are the grain producers. We make wonderful whiskey here, and we have been for decades. So why not us too?
And the Alberta spirit isn't the only noteworthy part of this bill.
It's AI entering into the core machinery of government.
The province used artificial intelligence to help write the legislation. It won't say what percentage is AI, only that it helped with research and data entry, and that humans had the final say.
This legislation is structured, it's repeatable, it's pattern-based. AI is good at all that stuff. The challenge is designing the workflow around it.
Alberta's government predicts this likely is not the end of AI assistance.
We're not really anticipating a world where AI writes all of our legislation alone, but we certainly anticipate one where AI can be one of the tools that we use.
Expect the Alberta whiskey title to be handed out to eligible distillers later this year. Tim Brooke, CTV News, Calgary.
All eyes are on Cape Canaveral as NASA inches closer to launching Artemis 2. That launch happening tonight. We've got more details coming up after the break. All eyes are on Cape Canaveral tonight as NASA inches closer to launching Artemis 2, a mission that will send astronauts around the moon for the first time in more than 50 years. Among the crew, Canadian astronaut Jeremy Hansen. Here's the latest in this report from CTV's Heather Wright.
With every passing second, Artemis 2 gets closer to liftoff.
The team is preparing. I think everybody's pretty excited and understands the significance of this launch.
This mission will be the fastest and furthest any crew has gone, a 10-day trip around the moon and back. The astronauts, including Canadian Jeremy Hansen, remain in quarantine, waiting for the first launch window.
He'll be spending time with people who are really close to him, family, and he's probably going to be going to bed really early and sleep shifting so that they can get on the schedule they'll be on for this moon mission. Now, whether or not he'll be successful, I don't know. Do you think you'd be able to sleep if you were going to the moon the next morning?
Joshua Kutrick is a Canadian astronaut who says a lot needs to go right for a successful liftoff.
It's immensely complicated. It is the most powerful rocket that's ever been built, and it's full of millions of high-tech components. So technologically, this is a very big challenge.
And the challenges are only going to grow. NASA has ambitious plans for space exploration, including a moon base by 2030.
I think of this as just the opening chapter in a grand story of astronauts going to and from the moon with great frequency.
To achieve those goals, NASA Administrator Jarek Isaacman says collaborating with international partners like Canada will be critical.
Canada is leaning forward with robotic expertise for our ambitions on the lunar surface. It's exciting to think about the potential when you're not just going to the moon for a couple of days, but actually trying to create an enduring presence for, its scientific and economic potential.
Canada was slated to provide a Canadarm3 for Gateway, a lunar orbital space station which has since been paused. But Canadian Space Agency President Lisa Campbell says many opportunities for Canadian expertise remain.
I'm very confident with the number of missions that are planned for the moon and beyond that agencies and countries like Canada, who have both a deep space heritage but also all sorts of new modern capabilities, are going to have lots to offer.
The launch window officially opens at 6:24 p.m. And while officials say there is an 80% chance of favorable weather, there are winds and cumulus clouds in the forecast. It's something NASA's weather officer is going to be keeping a close eye on as we get closer to launch. Heather Wright, CTV News, Cape Canaveral, Florida.
Just ahead, markets are getting a lift after U.S. President Donald Trump signaled the U.S. will leave Iran soon. We'll get perspective on that right after this. Stay with us. Hi there. Welcome to the second hour of The Open. Let's take a look at some of the stories we're following in the BNN Bloomberg newsroom. A new report citing several trade irritants between Canada and the U.S. includes provincial rules around alcohol and the federal government's Buy Canadian policy. The annual document prepared by the Office of the United States Trade Representative also mentions delays with aircraft validation in Canada and high tariffs on U.S. dairy products. Shares of GoEasy are taking a hit today after logging a deeper than expected loss in the fourth quarter. The results come after the lender recently surprised investors with a surge of bad debts in its vehicle financing business. The Ontario-based firm says it expects loan write-offs to remain elevated for a while before improving later in the year. And we're also watching shares of Group Dynamite today, which are getting a boost. The retailer reported fourth quarter profit that more than doubled compared with a year earlier. The results were driven by increased in-store demand and strong online sales. The retailer posted a strong outlook for revenue growth for the full year, but cautioned for multiple risks, including tariffs and a decrease in customers. We're obviously watching the markets closely today. The TSX up ever so slightly by 0.5% at the moment. This comes after we saw the TSX gain more than 800 points to close last night. So it seems as though investors optimistic about potentially an end to this war in Iran. U.S. markets, a similar story today. Really globally, markets are trading up. S&P 500 up, Dow Jones, NASDAQ as well up by a full percentage point. Everyone watching for this address to the nation later by U.S. President Donald Trump, where he's expected to provide some more insight into what exactly is going to happen in the Middle East. And as you are seeing here. Markets are reacting positively after U.S. President Donald Trump signaled he wants to wind down the war in Iran. Crude benchmarks eased earlier, but later pared back losses as uncertainty remains over when energy flows in the Persian Gulf could return to normal. So let's get perspective from Ed O'Gorman, CEO of River Wealth Advisors. It's great to have you join us. Good morning.
Thank you. Good morning. Glad to be here.
What are your thoughts on seeing majority of the markets kind of bouncing back today?
I think it's to be expected with, the market really reacting to news on Iran, and the market very much focused over the past couple of weeks on, impact on oil, looking for closure, some end to the hostilities and reopening of the Strait of Hormuz, of course. Ultimately, we're getting some good news here. We've had a lot of head fakes, a lot of confusion around where things are going, mixed signals. Hopefully, this is the beginning of the end, and the market's anticipating that clearly.
And you say you expect markets to refocus soon on earnings strength and broadening market participation. It is interesting, right? Because we've seen a lot of strength coming out of a lot of earnings reports, and usually the markets would be reflecting that. It hasn't been the case over the last month or so.
Yeah, I think we do get back to where we were January, February. And really looking back over the past year, double-digit earnings growth for S&P 500 companies for the past several quarters. Looking ahead for really broadening earnings performance here in the U.S. markets. And, we started to see that at the beginning of the year, a bit of concern over AI's impact across other industries. Some really divergence in terms of returns in individual sectors and subsectors, but generally a broadening of participation, which was really good to see given the concentration going on last year in mega cap tech stock names. So, I think we get back to that, and we get back to, focusing on earnings, focusing on where the Fed is headed, and really the fundamentals shine through again. But, for now, until we have some resolution or some sense of where things are headed, I think we're stuck in this period of volatility.
Yeah. You mentioned AI. So I want to ask, in terms of sectors that you like right now or that you feel would be good to invest in, is the tech sector one of them?
Well, yeah, I think given what we've gone through in this first quarter, significant correction in some of these big tech names. When we look at it from a valuation perspective, there appears to be some reasonable entry points forming. Certainly, we have the bigger picture that we have to take into account, but given the correction and the shift in markets out of tech and AI, there's certainly some opportunities there to look at some of the mega cap tech stock names, some of the software names that have kind of been thrown out with the bathwater, so to speak. We think there are good opportunities there. I think obviously the place we want to avoid right now, at least from an entry point perspective, is probably energy. Oil stocks really had a significant run, up almost 40% in the first quarter. So really kind of looking to maybe take some profits there.
Is there any other sectors you like, though? I take your point. You maybe stay away from the energy sector at the moment because we really don't know what's going to happen there. But in terms of like materials or industrials, are you interested in those?
Absolutely. I think, one of the things that's going on here that's been driving the market is the build out of data centers and just massive capital expenditures. Certainly a lot of that is going into chips and memory, but also, data center development that's impacting anything from heavy equipment manufacturers, materials, electrical component suppliers, connectivity, utilities. Really, it's a widespread boom in spending, and I think there are going to be a lot of infrastructure suppliers and developers that are going to benefit.
You mentioned staying away from energy right now because there's the potential for a reversal in oil prices. Do you expect that to happen soon, or what do you think? You're predicting the future here, but what do you think a realistic timeline would be for something like that?
I think it's hard to say what a realistic timeline is in terms of actually seeing energy prices revert back to, probably not to pre-war very soon, right? But to, at least seeing futures come down from the highs based on some diplomacy going on in the Middle East, but the actual, restoration of the damage that's been done is going to take some time. It will take some time for, energy prices to get back to sort of stasis. But, I think that what we'll see in equity markets is, an expectation of the future and discounting thereof. So, I would expect to see that the equity market and equities in that sector, really kind of come off the boil.
I did want to ask you about Nike. This is a story we're following closely today, obviously. This company, the stock price getting hammered right now, down more than 13%. That's the lowest it's been in a decade after the latest earnings report came out for this company. The turnaround plan by the CEO is not going quite according to plan. What are your thoughts on Nike's earnings? And is this kind of a broader story in terms of how consumers will be kind of behaving this year?
I think it's more of a Nike story than necessarily a broad consumer story. As you mentioned, Nike is in a turnaround scenario. Really pretty disappointing news in terms of their performance, primarily internationally in Asia. Their North America sales came in kind of right where they wanted them, a little above, but certainly not meeting the mark. And I think, like I said, it has a lot to do with Nike and what's gone on at Nike and their ability to grow revenue and product mix and really kind of competition in their space. It's tough to get a read on consumers overall right now. When we look at statistically, the numbers have been trending up. They've been fairly solid, but we really don't have a good read into how the impact of energy prices, of higher gas, diesel prices have really kind of read through to the consumer just yet. Mm-hmm. Certainly, the longer that lasts, the more dour the consumer's attitude is going to become on spending. But, leading into this, consumer here in the U.S. pretty solid, ticking a little bit higher in terms of sentiment reads and indicators. So above average retail sales mark today, again, that's February number. So we don't have a sense for really what higher gas prices and other energy prices will have on consumers just yet.
Got it. Okay, well, we'll have to leave it there. We're out of time. Ed O'Gorman, CEO of River Wealth Advisors. Thanks for joining us today.
Thank you very much.
Still ahead, the Artemis 2 mission is set to launch this evening, and we spoke with the Canadian company working with NASA to make it happen. That conversation with Mike Greenlee is coming up after the break. NASA is expected to launch a new rocket to the moon today called Artemis 2. And Canadian astronaut Jeremy Hansen will join the crew and become the first Canadian to leave the Earth's orbit and venture to deep space. And Canadian space company MDA Space is also part of this historic moment. For more, we spoke with Mike Greenlee, CEO of MDA Space.
It's a historic day. It's the first time that humans have been back towards the moon in over 50 years. The first time that a Canadian has ever gone to the other side of the moon. And this group of 4 astronauts will be it'll be the furthest that humans have ever traveled from the Earth. And so that's the historical aspects of the moment. And it's the opening of a new phase, of opening up a new economy. So for the Canadian space industry, which we're a key member of, the opening up of the return to the moon, the establishment of living and working on the moon, which Artemis program is constructed to achieve over the next several years. This is the first very important step in doing all of that, with this group going out around the moon today. And then the next group in 2028, there'll be 2 landings on the moon with humans starting to set up living and working there.
All right, I want to bring Nate into the conversation. Nate.
Mike, this is a great day, exciting day for you and everyone involved. For Artemis in general, obviously one of the big goals is to return to the moon, but what are some of the other main goals of Artemis over the coming years?
For sure. Well, the primary singular sentence is to live and to work on the moon, for sure. That causes us to sort out as a space community all sorts of different issues, determining how to have the reusable rocket systems that can go back and forth to the lunar surface, to be able to put communication systems on the moon, which MDA Space will be a part of or is currently a part of, to be able to put rovers on the moon, to be able to drive around once you're there and move logistics and cargo, to be able to build habitats, to be able to look at the ability to have sustainable food sources on another planet, and then to start to explore that planet in terms of looking at what types of resources can be available to be able to do things like create fuel, to be able to then have bases from the moon, to be able to move on to further out into the planetary system. So a whole series of technology achievements will be part of the Artemis missions. In addition to a lot of human science achievements, we've studied the performance of humans in space for the last 25 years on the International Space Station. Now, obviously, putting all of that to work to be able to continue to study and advance having humans live and work on another planet with different characteristics as we now figure out how to live and work on the moon.
And for MDA itself, Canadarm3 is a big thing for you. NASA may not be using that now. Where do you see yourself fitting in with Artemis and with the space programs in general?
Yeah, for the Canadarm3 program is Canada's program to contribute space robotics to the Artemis program. Canada, of course, through the Canadarm history, is the world leader in space robotics with the most experience of any nation in this regard. And so, right now we're in review to look at, can we take the robotics that has been targeted and been developed for the lunar area, previously targeted at Gateway, the space station that was to orbit the moon, which has now been paused to focus on getting onto the lunar surface, and then target the final design of those robotics at the uses on the lunar surface. There'll be a number of robotic needs on the lunar surface to be able to unload, manage cargo, do daily tasks. And so, we're looking at that at the moment. So as a company, we would expect to continue to be involved in robotics on the lunar surface, where we have a very strong rover capability. MDA Space has had technology on rovers on Mars for the last 15 years. We've been involved in the design of a new rover system with the European Space Agency and various teams for Mars called ExoMars, which is planned to go up in the future. And we're involved in a couple of different lunar rover programs to put rover systems onto Mars. And so for sure those items, and then we're involved in a range of other conversations where our technologies will be applicable.
Nate, I just wanted to ask one quick follow-up question. What's it like to try and adapt something that you had for going around the moon? Now you got to look at it for maybe being on the moon. How easy or difficult is it to do that?
A lot of things are the same, like the command and control and communication systems, figuring out how to have robotics control instead of 400 kilometers up at the International Space Station, now doing that 400,000 kilometers out at the moon. All of that is the same. Those robotic systems have been built for that and designed for that environment. In addition to dealing with things like lunar dust, for example. And so a lot of the characteristics are the same. The biggest change from going to a space station down to the surface would be the impacts of gravity, because now you have a gravitational field that's there. So you'd have to have, you'd probably change your joint strength, for example, in addition to maybe your segment lengths of your robotic system for different tasks and different purposes. So definitely an achievable adaptation for Canada to consider to be able to continue to contribute robotics to the lunar surface.
All right, Nate, we'll give you last question.
Mike, you previously mentioned traveling beyond the moon, and I think a lot of our watchers would love to know, what does this mean for Mars and the likelihood of humans being on Mars in some time in our lifetime?
All of these activities on the lunar surface is definitely in preparation to be able to go further and to be able to live and work on Mars someday. So with the moon being a much closer planetary planet to work on, then that allows us to be able to work out all the issues around sustained rocket highways back and forth to the moon, to be able to move people and logistics back and forth to a habitat there, to be able to work through all the issues around habitats, living and working, food, everything I mentioned earlier. So the lunar program is important for the moon itself, but it's also important to sort out all of those issues so that we can go even further away to Mars in future years.
That was Mike Greenlee, CEO of MDA Space. Still ahead, Canadians move billions through e-transfers, but what if that money doesn't actually show up? We've got more on that next. Canadians send over 1 million e-transfers a day, but what happens if information is entered incorrectly and the money goes missing? CTV's Pat Foran investigates in this report.
I thought, oh my God, what have I done?
Tony DeSimone of Toronto says the very first time he sent an e-transfer, he had a problem.
I'm blind in my right eye, so sometimes I have difficulties doing emails or texts and things like that.
He owed his sister $1,600, so she told him to e-transfer her the money at Christmas time, and she gave him her email address.
I kept telling my sister that I sent it. And normally she gets an email saying, that there's a deposit in her account from an e-transfer.
When the money never arrived, he took another look at the email he used and realized he forgot 2 numbers and he sent it to the wrong email address. His credit union said the person had auto deposit and the money went straight into their account.
You sent it to the wrong person and now it's been deposited and we can't get it back.
The Windsor Family Credit Union said once an e-transfer with auto deposit has been successfully deposited, it cannot be reversed without the consent of the recipient. When DeSimone reached out to the person and explained the mistake, they were concerned it was a scam and refused to send the money back. To avoid e-transfer trouble, treat e-transfers like cash. Make sure the person you're sending it to is trusted. Double-check details before sending, and if the person has auto deposit, a pop-up will validate it's the right person. DeSimone says losing $1,600 has affected his finances.
I feel really bad, and I want to get my money back if it's possible.
When CTV News reached out to the person who mistakenly received the funds, they said they'd been scammed before, but now realized it was a mistake. So the person sent DeSimone back his $1,600, which was great news for him.
I'm so happy, that I watched your show. Thank you, CTV. I'm glad I got my money back thanks to you, and it wouldn't have happened without you guys.
That was CTV's Pat Foran. Well, shoppers getting ready for Easter are facing higher grocery bills. The rising prices for meat and chocolate are forcing many to look for cheaper alternatives or to scale back. CTV's Tyler Fleming reports.
Is it more expensive? I'm not sure. Oh, yeah.
This holiday ham from Costco, nearly $9 a kilo. A good deal for Eric Shear.
I'm going to say last time I bought this, it was probably 30-ish.
Compared to last year, up about 10%, in line with overall rising food prices.
Refrigerator.
To help offset the cost, this family is going with a potluck.
I'm responsible for the ham, so this is like my only responsibility, so it's not that bad even if it goes up a little bit.
New consumer data shows year-over-year meat prices, especially beef and chicken, are climbing fast.
The prices of oil in particular have surged, and that increases the cost in every step of production.
At Pete and Gus Meat Market, Case DeCarlo says while some shoppers are switching to other cuts,
this year I'm seeing people getting a lot more pork, a lot of hams, crown roasts, and the like.
His business is holding strong.
I'm actually picking up Pete and Gus's famous breakfast sausages for 2 of my other kids and delivering them. They've always liked these breakfast sausages, so that's going to be part of their breakfast for Easter. You come to a place like this, you know you're getting good quality food.
This guy is just an adorable little treat to put in your Easter basket.
It is not just dinner. Chocolate prices have soared amid supply chain shortages.
I'm also seeing more filler ingredients go into the products, palm oil, just more sugar, and less cocoa.
But that's not the case at White Pine Chocolates.
I've decided to stick with small Easter gifts this year.
Where owner Wendy Peterson says the value is in the bite.
And you know that there's a lot of love put into it, both from the farm all the way to the chocolatier. I think that's special, and that makes a little luxury indulgence worthwhile.
Some families may even push back this year's egg hunt.
It's supposed to rain a lot on the weekend, so we figure we're going to do it the next weekend, maybe get some discount Easter chocolate.
Tyler Fleming, CTV News.
Still ahead, as much of the world grapples with a fuel crunch tied to the war in Iran, Suncor Energy says it wants to ramp up production. We will hear from the CEO right after the break. Finance Minister Francois Philippe Champagne is in China for the next 4 days. The trip is aimed at building closer strategic and economic ties. His office said the visit would build on Prime Minister Mark Carney's trip to China in January, adding he will meet government and business leaders to build strategic partnerships and attract new investments. Shares of Tilray Brands are falling today. The cannabis company issued a full-year profit outlook that beat estimates, but investors seem to be focused on its beverage division. That unit continues to face headwinds and saw sales drop 24% compared to the year before. Tilray has been expanding its portfolio of craft beer and spirits labels, and most recently bought Brewdog's operations in the UK, Ireland, and Australia. And shares of Nike are plunging after the sportswear giant gave a gloomy outlook for the year ahead. Revenue is expected to fall up to 4% in the current quarter and continue to be in the low single digits for 2026. Nike is being impacted by elevated inventories in Europe and the Middle East, as well as traffic disruption from the war. Weakness in China and other markets also overshadowed strong results in North America. And we're watching North American markets today. TSX getting a boost up by 0.6% after seeing a real boost yesterday. American markets, similar stories here. We're actually seeing the same story in Asian and European today too. But U.S. markets all getting a boost. The Nasdaq up by more than 1% as investors watch to see whether there's any developments when it comes to a potential end to this war in the Middle East. And of course, that is affecting the price of oil today. We're watching a couple of commodities pretty closely. Oil is down by more than 2%. Again, if that war ends, that Strait of Hormuz could potentially open, and we'd see the price of oil continue to potentially drop. And we're seeing that today. Also watching reaction as gold has been getting a boost over the last couple of days. It's up currently by more than almost 2% at this point. Up next, as much of the world grapples with a fuel crunch tied to the war in Iran, Suncor Energy says it wants to ramp up production. We will hear from the CEO when we come back. As much of the world grapples with a fuel crunch tied to the war in Iran, Suncor Energy says it wants to ramp up production, boosting output by 100,000 barrels a day to nearly 1 million barrels a day by 2028. That target is part of a series of ambitious goals laid out at the company's Investor Day. And for more on Suncor's path forward, Andrew Bell spoke with the company's CEO at the TSX. Take a listen.
We're talking to Rich Kruger, CEO of Suncor, one of the biggest players in the Canadian energy industry. He took over at Suncor almost 3 years ago. 3 years ago this week, the company was out of favor with investors. The safety record was spotted, and the company had operational problems. Since then, we have seen quite the rally in the stock, and the company is out there telling investors this week in the States and Canada what its plans are for the next few years. Rich, thanks for giving us the time.
My pleasure.
One number I think that jumped out for people yesterday in your presentation. So you're saying that your break even for WTI, and it's a complex calculation, is about $43 US. And that includes the base dividend.
That's right. That includes our sustaining capital and our base dividend. 2 short years ago, that was more like $53 a barrel. So we've lowered it by $10 a barrel over the last 2 years.
And does that break even in profit or cash flow?
Well, it's really more of an indicator on a kind of a cash flow basis, but it's a common denominator that companies can use to compare themselves, and it really deals with your strength and resiliency with commodity price cycles. So in a low $40 a barrel, that would put us very, very competitive on a global basis.
You're a former head of global production at Exxon, so I'm really looking forward to hearing what you have to say about the Strait of Hormuz, but let's stick with Suncor for now. And you're saying that within 3 years, you hope to bring that break-even price down to about $38 US?
We had an investor day 2 years ago where we laid out a 3-year plan, and we delivered on every commitment in 2 years versus the 3. Yesterday, we put out a new 3-year plan that has a further $5 a barrel reduction in break-even, another 100,000 barrel a day growth in upstream production, and significantly material cash growth, cash flow growth to our shareholders. So we think it is both ambitious and bold.
And this year, your production will be something like 850,000 a day.
It'll be between 850 and 860 probably. This year is a bit more of a higher maintenance year, but it's on an upward trajectory. It's grown 114,000 barrels a day in the last 2 years, and we project another 100,000 barrels a day in the next 3.
I remember, I think this must have been under you at Imperial Oil, a previous gig. You produced a safety video, and we showed it. It was on YouTube, and it was really quite striking. It showed an accident, you know, that could occur with trucks and big equipment. It was quite a stark video. So safety was an issue at Suncor when you took over. There had been deaths, and the record has improved.
Well, I think to consider yourself a good or a great company in oil and gas, you must be a safe company. And so the priority for the last 3 years has been on the safety of our people, our employees, and our contractors. And I'm really proud to say that we have reduced injuries and incidents 75% in 3 years, now placing us as one of the safest companies in North America.
So in terms of your getting money back to shareholders, you're paying them back something like $2.5 to $3 billion a year in dividends, and the same in share buybacks.
Yeah, this year, in fact, our dividends will be roughly about $2.7 billion this year, and we've increased our buybacks where it'll be just about $4 billion in 2026, materially increased over year on year.
What do shareholders tell you, or bigger institutional accounts? We like dividends, we like share buybacks.
You know, the shareholders they're a diverse mix. They like a bit of it all, but I think the predictability and reliability of a dividend is important to many. Yeah. And as opposed to holding surplus funds when we have it, the majority of shareholders would prefer that we would return that capital to them via buybacks. And with our cost structure where it is, our spending where it is, we're able to do that.
It's interesting right now, the bulk of your production is from the mining, the big trucks that the industry can do with the shallower bitumen deposits. But over the next decade and more, you're moving into in situ, getting it out using steam and other techniques.
We are. One of the things we've done over the last few years is a comprehensive assessment of our resource base, looking at delineation drilling, shooting seismic, the size and quality of it. And we published literally this week an 11 billion barrel addition to our contingent resources, taking us from 19 billion barrels to 30 billion barrels. That is nearly a century of reserve life at today's rates. And so when we look at our future opportunities, it's both large and high quality. That's where we see a shift over time in the company's production.
Yeah, thanks for reminding me about that. So you're saying it's contingent resources up to almost a century. So at current production rates, you could keep going for a century?
We could. That's on top of the 25 years of remaining life we have with our proved and probable resource base. So yeah, I would say Suncor's resources could probably outlive both you and I, Andy.
Unless they come up with some good technology, yeah.
You might have a leg up on me.
No, I think we're in the same boat. That's interesting because, I mean, as former head of production, a global head of production at Exxon, are there any deposits in the world that are like that?
Yeah, one of the big attributes of a company that, to me, an oil and gas company that determines its quality is its longevity and durability of its resource base. Yeah. With more than a century of undeveloped resource ahead, that puts us in a class of our own. Canada and perhaps Venezuela with its heavy oil deposits would probably be the only two places that could have that conversation.
But of course,
they've got other issues.
Yeah.
Got other issues.
What about a global company like Shell or Exxon, or what kind of reserve life would they have?
Typically, the public companies report their proved reserve life, depending on what they report on, but it could vary between plus or minus 10 years or so. That's not specific to any one company. Yeah. Some are less than 10, some are slightly more than 10.
Yeah.
But the Canadian oil sector, and Suncor in particular, with a 25-year reserve life, that is uniquely long.
So just remind us, what percentage of your production is mining and how much is in situ right now?
Today of our bitumen production, about 70% is mining, 30% is in situ. And as time goes on, we see that mix shifting, whereas if we project about 15 years from now, we would be perhaps 60% in situ, 40% mining. It's still large in both, but the opportunity set ahead of us is more in situ oriented or thermal.
And you say that you get twice the cash flow per in situ barrel?
One of the things that we're uniquely advantaged of is because of the concentration of our resource base, we can utilize existing facilities to help our subsequent developments. So they're more brownfield in nature versus grassroots or greenfield. And so when we do that with in situ having a lower operating cost per barrel, you generate more cash flow per barrel as you develop incremental in situ barrels.
Now you're trying to cut back natural gas use, of course, but it's still, you use a lot of natural gas, the industry in situ. But I was surprised, you're telling me that the cost of an in situ barrel, only about up to 15% of that is the actual natural gas.
Yeah, natural gas is used as a fuel for our steam generators and with the steam used in the in situ operations. And that is it's material. It's like all costs. We look to control it, but it's relatively minor in the grand scheme of our total cost structure.
Right. I'm always curious. Natural gas prices have been low for quite a few years. So if there was a rapid run up because of LNG or whatever, it's not a deal breaker for you then.
No, it's not. But some of the things we're doing to build in further safeguards, we're using increased solvent in lieu of steam. We're using non-condensable natural gas.
What is that? I'm sorry.
It's when you have a reservoir heated. Think of it as your oven. When your oven's, you crank it up, you're going to cook your turkey at 375.
Yeah.
You don't need to continue to put more and more heat into it. So what we do when our thermal chambers have been heated, we pull back on steam injection and we substitute non-condensable natural gas, so you still retain the heat and maintain the pressure. So you can redeploy that steam in other uses. So it's a big step in efficiency. It lowers costs and it lowers emissions, emission intensity per barrel. There's a series of benefits with both solvents and non-condensable natural gas.
Sorry, what is that term, non-condensable?
It just means it doesn't compress as you inject it in. It retains the volume in the reservoir. It doesn't collapse.
We better get to the Strait of Hormuz. You've been around for a while in the industry. Have you seen anything like this in your career?
I would say it's quite unique. I've been in this industry 42 years, and you see the inevitable ups and downs with commodity economic cycles, geopolitics, but the straits in particular, with the concentration, how much oil and LNG go through that, we're in very unique times.
I know you're not a military guy, but can Iran keep disrupting traffic there if they want to?
Again, it's that one's above my pay grade. I have a hard enough time running an oil company. I'd hate to speculate on geopolitics in the Middle East.
And just 10 years from now, where will most of the world's oil be coming from?
Well, this is a fascinating thing because there are roughly 10 countries on this planet hold nearly 90% of the world's remaining oil resources. 10 countries. Canada happens to be very high on that list at number 4, and that's why the potential for our country is just tremendous, not only now, but for decades and decades to come.
Who's bigger, Saudi?
You'd probably say Saudi, Venezuela, and Iran are right up there in the top 3. So if you go through that list of the top 10 and you look at, where do shareholders want to invest their money, and from a safety and confidence and comfort standpoint, I would say Canada needs to be near the top of that list.
It is time now for Hot Picks, and today we're zeroing in on 3 energy stocks to power up your portfolio. So let's get more perspective now from Jay Hatfield, founder, CEO, and portfolio manager of Infrastructure Capital Advisors. It's great to have you join us. Thanks so much.
Thanks for having me on.
Before we dive into these picks, are these good if the war goes longer than expected, or are you a fan of these regardless?
Well, we do think that the midstream, these are companies held by our AMZA ETF, is a good long-term asset class. Obviously, they've been doing well during the war. They will, to be fair, if the war is resolved, they'll underperform, but they're great long-term investments with great yields. And they really were flat last year. So they're starting off a very low valuation base.
Okay, so let's get to it then. Your first one is Cheniere. Why do you like this one?
So Cheniere is the largest exporter of natural gas from North America. And, you know, we're all in one basin, so it's better to say North America than the U.S. And what's really great, like I said, it's underperforming today and will underperform, but they have a huge long-term opportunity because there's been a disruption, not just a disruption, but the natural gas export capacity of Qatar has been damaged, and they're saying it's going to take 3 to 5 years to replace that. And they're growing their capacity export, and they also benefit from these higher spreads on natural gas between the U.S. and the rest of the world, but particularly Europe. So a great long-term investment that was overlooked. So it's run a lot, but it ran from a very, very low base.
Your next pick is seeing quite a rally today, up almost 7% at the moment after NVIDIA said it's going to be investing $2 billion in this company, Marvel Technology. That's not bad for this company. What is it? Was this kind of your pick before we heard about that investment from NVIDIA?
It was. It's the largest position in ICAP and also our hedge fund. That's our large cap income fund. And the reason for that is that we are very laser focused on valuation. And this company really went out of favor. They gave some conservative guidance, not because they had a problem with their company, but just they were operating conservatively and their stock got smacked. I think you can see that in September of that chart. And it's really been out of favor since then. But it's a fantastic company. They have ASICs, but also optics. And that's really why you saw the investment from NVIDIA. So they're growing at 30%, trading at about 20 times. So a 2/3 PEG ratio. So extraordinarily cheap. We have a 180 target. So we've been adding to it, you know, even after that news came out about NVIDIA at 95. And so we still think it's super cheap, super high beta too. So it's kind of the opposite of Cheniere.
Is there any risks that are associated with this company that you're kind of watching for?
Well, I don't think there's a lot of operating risk because the fundamentals are just, we just raised our numbers because there's more opportunity with NVIDIA. But as I mentioned, I think the beta is about 2.3 times. So if we're wrong about the war, we do think it'll get resolved in the next couple of weeks. This is not where you want to be. You want to be in the Chenieres and other defensive, either pure energy like Suncor you had on or the midstream.
Mm-hmm. Okay, lastly is Energy Transfer LP unit. You say pipelines are a very defensive sector, so you like this one for that reason?
It's even more defensive than Cheniere. It trades at about 13 times earnings. It has a 7 yield. And so it hasn't even run up that much, you can see from that chart. So a defensive way to get a good total return, grows the dividend about 5% a year, 7% yield. So you're going to be, even if you're wrong in the short run and the war resolved itself, you will be have a great total return investment. It's a little bit like a bond. So it has a low beta or low risk correlation to the market like a bond does, but good yields. So not going to be super exciting, but great because it does do well when the rest of the market's doing poorly.
Okay, so as we've been talking about, like you expect there to be clarity when it comes to the reopening of the Strait of Hormuz by mid-April. But obviously we've seen a lot of the impacts throughout the markets since this war began. The private credit market really getting hit hard. You say you believe losses in the private credit market in the absolute worst case will be about 5%. Why do you think that?
Well, that's really the worst case. So that assumes a 10% default rate, which was what happened during the great financial crisis, and then a 50% recovery rate. But yet in the market, particularly we like stocks that have low exposure to private credit, but are down 30 or 40%, but BDCs that have direct exposure down 30 or 40. So 10% really is quite a draconian case, like I said, during the great financial crisis. So I think investors have overreacted. In March, these short theses tend to be overplayed because there's no earnings. So we think it's a great opportunity to buy, particularly companies like KKR that are outside the blast zone, actually have low exposure to private credit. So as usual, the market has overshot, and that's why we all have jobs, because you can go in and do the work and then enter these super discounted sectors.
Speaking of markets overshooting a little bit, we saw that kind of at the beginning of the year when it came to that software sell-off because of AI. A lot of investors worried about what AI could do to a lot of the software sector, some software companies. What do you think's happening there? I mean, are we seeing a rebound with these software companies, or do you think AI is going to kind of take over again?
Well, what we thought was interesting about that sell-off or that short selling bout was that there was two reasons to not buy AI. The first was that there was no applications for AI, so all the infrastructure was going to be a waste. And the second was that there were going to be infinite amount of applications is going to destroy the entire software sector. So the lowest risk way to play that, in our opinion, is to go after the infrastructure plays. So Marvell's a good example of that, and not necessarily weigh into exactly which software company is going to be successful. It's clearly going to be highly competitive. It's not clear who the winners are. So we'd rather go safer. Amazon is a great retail company and has AWS. So go into the infrastructure plays first, and then let the software companies kind of sort themselves out as to who really has the traction with the customer and is going to benefit from AI and not be penalized by AI.
For sure. Okay, we'll leave it there. Jay Hatfield, founder, CEO, and portfolio manager of Infrastructure Capital Advisors. Appreciate your time. Thanks so much.
Thank you.
Coming up, we will head to Cape Canaveral, Florida, as the countdown is on for NASA's Artemis 2 launch. That's set for later today. More on that right after the break. Later today, NASA astronauts are set to launch on a 10-day journey around the moon, marking humanity's return to the lunar vicinity for the first time in more than half a century. So for more on this, we are joined by Lauren Grush, a global space reporter for Bloomberg News down at Cape Canaveral. It's great to have you, Lauren. How are things going there?
Things are, at the risk of jinxing anything, they are going as best as we could possibly want them to be. They're currently loading propellant into the rocket right now. That process seems to be going smoothly. The astronauts just woke up, I think, a few minutes ago, or maybe 30 minutes ago at this point. So they're starting to get prepped and ready. So all things seem to point to a launch today. And as you can see, the weather looks really nice. We have an 80% chance of favorable weather conditions. So I don't think we could ask for a better setup for this launch today.
Well, and that's the thing, right? I mean, this comes after there was a couple of delays in this process. Can you walk us through kind of what it took to get to this point?
Absolutely. So, a couple months ago, NASA did something called a wet dress rehearsal, where they basically run through all of the procedures that they would on launch day. They fill the rocket with propellant. And, that first time they did that, it had a little bit of issues. There were some leaks, but then they did it a second time, and that seemed to go really well. There was a helium issue that popped up right after that. They had to roll the rocket back to its hangar, this big hangar you see behind me. But then they were able to fix that, roll it back out to the launch pad, and that seemed to have done the trick. I am a superstitious person when it comes to these launches, so I don't want to say everything is great, but so far so good.
There seems to be, obviously space exploration is very important, but there seems to be a bit of a global race back to the moon, right? Like geopolitics and politics are definitely at play here. Can you walk us through kind of the importance of that?
One of the questions I get all the time is why? Why are we going back to the moon? And if you ask lawmakers and White House officials and even NASA executives, they'll tell you that, we are in a new space race with China. There's concern that, China is also looking to land humans on the moon.
Yeah.
And if we don't get back there before then, they could set up some kind of perimeter that would make it harder for us to explore.
For sure. Okay.
We're trying to get back before that happens.
For sure. Lauren, sorry to interrupt you. We'll have to wrap that up. That's Lauren Grush from Bloomberg News. Thanks so much for joining us. Appreciate it. And that wraps up this edition of The Open. Morning Markets with Roger Peterson is next. Stay with us.